I'm going to be talking about how a credit builder credit card issued by Synchrony Bank that was supposed to help me build my credit ended up really hurting my credit. And so the context here is that in February of 2019, I applied for a normal credit card on Amazon.com. I was rejected because my credit score was too low. Why was it too low? It was because I've never had a credit card before, and because of that, what's worse than a low credit score is a no credit score. Hence, I was rejected. And so I wanted to have a credit card because I want to start building a credit. And it's like a catch-22 where how do you start from nothing? And so there are options out there like credit builder credit cards. And so they had this option with Synchrony Bank that I elected to go with. And I read the terms very carefully. I spoke with the agents on the phone to make sure I fully understood how to set up autopay so I would never miss a payment, and understand the credit limits and all these things. And so basically with this credit builder card that I got, the way it worked is because I was such a risky investment to make from a bank's perspective, or a risky borrower, I gave them $500 up front for a $500 credit. So like the worst case scenario is that I ran around, spent $500 on this credit card, never paid. They already had $500 of mine that they could keep. And so those were the terms for this credit builder credit card, is that, I didn't need to have really any credit score to get it because I was literally giving them the money up front to even have a credit card in the first place with that max limit. So they were literally taking on basically zero risk to have me as a credit builder, and upfront, and the expectation was that this card would help me improve my credit score from no credit score to a better credit score. And the reason why good credit scores are needed is that they dramatically save you hundreds of dollars down the road. If you're thinking about a car loan or a home loan, having a good credit score saves you a lot on the interest rates that you get. Hundreds of dollars, potentially thousands of dollars, it really depends. But if you have a good credit score, you will save a lot of money when you borrow for things down the road. If you ever want to own a home, for instance, it will save you hundreds or thousands of dollars each month. So it's big dollars, and it's stuff that I wish I was doing sooner, and I wish I knew these types of things, earlier on. So, credit score is a very tricky thing to understand. It's taken me a long time just to understand it as much as I did. And I was talking with my mortgage broker the other day, and I've been learning these lessons the hard way, and I wanted to share them with you guys so that hopefully you don't make the same mistakes that I have. But basically, the number one thing on your credit score is, do you make payments on time? This doesn't mean you have to make a full payment every time. You have to make at least the minimum payment each time. Having any late payments is the worst thing you can do to hurt your credit card. So if you've maxed out your credit card and you can't pay that, paying the $35 or $25 minimum at least keeps your late payments at zero. You'll have to owe interest on the remainder, and it's going to be a lot. It's usually around 27%. If you have like a no credit or a bad credit score. But that is how it works. But you are keeping your credit score good by making on-time payments. That's like number one. Number two is, how much credit do you have available to you? And again, it's a catch-22 of the situation where you need to demonstrate that you're able to hold on to your credit, like have a credit card with a $1,000 line of credit, and it looks good. So a person who has demonstrated that for the last 10 years, they've been able to have $10,000 in credit available to them looks a lot better than someone who for only 1 year has only had $100 of credit available to them, or $500 of credit, like in my case. So that number, like the summation of all of the credit cards you have, is your total credit available to you, and just demonstrating that you're able to have the option to go out and go to Best Buy and buy all the plasma screen TVs you see, but you don't do that, is basically a good thing. You're not always doing that. The other part of that, so how much credit do you have? Bigger numbers are better. Having $100,000 of credit available to you and showing that self-restraint is a thing that helps you increase your credit score over time. The next part of that, which I've been alluding to, is that credit utilization. So of all the credit available to you, are you someone who's always maxing out your credit card? It doesn't look good if you're always maxing out your credit card. Ideally, you should be using around less than 30%. The number varies, but you want to keep it low. And one way you can keep it low is by often making payments and keeping your balance as low as you possibly can. So having a very high revolving account balance looks bad to a bank because it looks like you're that type of person with that $100,000 line of credit who's always maxing their card. And so you're at a high risk of not being able to make a payment So it doesn't look good. So basically, you're going to demonstrate that you would have a low revolving credit utilization across all of your accounts. So they want to see that like you've got a lot of money available to you and that you don't really use any of it. That doesn't mean you never use it. You should use it a little bit just to show that you've got credit activity. Plus, the carrot that the credit cards throw at you is the fact that like, on Amazon.com, that credit builder credit card gets you 5% back on a purchase of like, so if I buy something for $20 or the grand total is $20, I'm gonna have $1 in reward come back to me. So it's a nice little perk of having these credit cards in the first place too. But again, credit utilization makes a huge impact here. So do not max out that card, even though you're like, wow, I can get up to $50 a month if I max out my $1,000 on this, credit builder card or whatever. It will hurt you. So very, very important to make note that credit utilization, amount of credit, and then finally, the age of your credit is also important. And the reason why it is because at any point in time, you're going to have a certain number of open accounts. And all of your accounts that are open, it looks good to a bank to see that those accounts have been open for a long time. And so in my case, so what they do is they basically average all those scores. So like if you've got 3 credit cards, the first one was open for 10 months, the second one was open for 20 months, and the third one was open for 30 months, your average credit age is 20 months. And so, in that case, that is your average credit score. If you then decide, if the 30-month card decided to close out, or you're like, I paid this thing off, I'm going to close it out. Well, now the next month, when they recalculate your credit score, they're only going to be looking at the 10 and the 20 month. So even though you had that old credit card, it disappears from your credit report, or the TransUnion or Equifax, who are those rating agencies basically of your credit score, are going to only see 10 and 20. So they're going to say, well, your average age of credit just dropped from 20 months down to 15 months for that 10 and 21. And so basically that really hurts you too, because it doesn't look good from the bank's perspective to see that, you might have a lot of credit available to you, and you might not you might be showing that you're not really using it, or you're not always maxing out those cards, which is great, and you're making all those on-time payments, but by closing out cards, that really hurts your credit. And so in my case, what happened with this credit builder credit card that I had with Synchrony Bank is that account was supposed to be open indefinitely. And when it got to 40 months old, for whatever reason, they decided to just close out that account. And so I had been doing everything to the best of my ability right. I never missed a payment. I was keeping my credit utilization low. I was trying to open up additional credit cards early on so that I could show that I could have and maintain a large credit available to me. But Synchrony Bank, with their credit builder credit card, coming in and closing out without even asking me, the account that had been for 40 months old dramatically decreased my average age of credit, which hurts my credit score. And so yesterday when I was talking with my mortgage broker, because I'm thinking about maybe getting a home and I want to know how much it's going to cost me, because they did that, it decreased my credit score, which increases my interest rates. And so basically I'm going to have to spend hundreds of dollars more every single month in interest payments if I want to own a home, because of the fact that Synchrony Bank and their credit builder credit card decided to, on their own, close out this account. And I called Synchrony Bank today to ask them, why was this account closed out without me ever being informed of it or having a choice to keep it open? And the only thing that the rep told to me was that they had no idea and they just closed it out, and they said that they cannot reopen their closed accounts. And then he also told me that if I wanted to, I should reach out to TransUnion or Equifax, who are those rating agencies, and ask them, why did Synchrony Bank do this? And I told him this seems to me to be a very ridiculous thing, because Synchrony Bank writes their own policy on their credit builder credit card. So I have no idea how TransUnion or Equifax are in any way related to Synchrony Bank deciding to, on their own, close out an old account, which really hurt my credit score. So the credit builder credit card that was supposed to help me at the end of the day hurt my credit score, and is going to, if I decide to get a house or a car, make me pay more interest every single month because of it. So it impacts me directly, and I've tried to do everything right. And to me, it's a very frustrating situation to be in with these people, is that, they've created this system of rating humans based on their credit worthiness. It's an incredibly complicated way of understanding the system, because ideally, I think we all want to show that we have the best credit scores we can, because, you want to show the bank that you're a credible borrower, and that they'll get their money back over time with interest. But it's very hard to understand when other factors come into this picture that are completely beyond my control and ruin my credit score. Stuff that I had no control over. Synchrony Bank deciding to just close out an old account really hurt my credit score, and I had no say in that. So I don't understand how I'm the one responsible who has to now bear the burden of paying a higher interest rate because I now look like I'm a less trustworthy borrower because of something that Synchrony Bank on their own decided to do. So that's my little rant here. I am frustrated by this stuff. I don't think it's fair. I don't think it's right. And I wish we had a better system in place for governing how these things work. And that's going to wrap things up for this video. I hope you guys are not in similar boats, but if you are, stay strong and do your best to just keep building that credit and know that it probably, hopefully, will pay off someday. But thank you again for watching. Be well, and I will talk to you guys next time.